Hello, fellow compounders. Charlie Munger, Warren Buffett's longtime partner in Berkshire Hathaway, said that to solve hard problems, you should invert and look at them from the other side. Therefore, in order to make money, we should avoid losing it. So in this video, we're going to review my list of the top 10 reasons I think that people lose money investing so you can avoid them. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. I'm a full-time investor and CFA charter holder. Welcome aboard. So let's get started. We'll go in reverse order to make the list interesting. Reason number 10, being a lemming. Blindly following tips from friends and other investment gurus will get you nowhere. When you follow a tip without doing your own research and critical thinking, you won't really know your investment. You will not know why the business is a good investment, and you will not know when it stops being one. So don't be a lemming. Reason number 9, not doing research. Peter Lynch said that investing without research is like playing stud poker and never looking at the cards. If you do not do your homework and don't know how the business makes money and don't know its strengths and weaknesses, you're just betting on a horse because you like the name. Don't do that. You will lose your money. Reason number 8, not having an investment plan. Without a plan, you don't know your objectives and you will not have the discipline to invest. Like in all ventures, if you fail to plan, you plan to fail. Reason number 7, impatience. This causes you to trade too often, not allowing your business to compound. Warren Buffett once said that something that he really regretted was selling Disney. He bought 5% of Disney in 1966 for $4 million, which he sold a couple of years later for a small profit. That stake would be worth currently $10 billion, or 2,500 times his original investment. In addition, when you trade often, you incur more taxes. So be patient. Reason number 6, forgetting about inflation. Most people forget to account for inflation and only think in nominal terms. Inflation is like a silent ninja robber that steals your purchasing power without you noticing. You can think, or you should be thinking in real terms, seeking real returns. For example, if you receive a 6% return on your investments, but inflation is running at 8.5%, you're actually losing 2.5% in real terms. You're losing money against inflation. So your purchasing power is decreasing and you're losing money without realizing it. Losing 2.5% of purchasing power per year means that your purchasing power would be cut in half in 27 years. Reason number 5, you don't know what you don't know. Warren Buffett said that you should invest in businesses that you understand, that are within your circle of competence. The worst thing to do is not to know the boundaries of your circle of competence. If you invest in things that you don't understand, you are gambling and most likely you will lose money. Reason number 4, not knowing the difference between price and value. Price is what you pay and value is what something is worth. To understand the value, you need to know how to value a business. We believe that a business is worth the discounted cash flow of what the business generates. Reason number 3, not knowing whether you are investing or speculating. According to Ben Graham, an investment operation is one which, on thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. For example, if you are buying a stock in a business, let's say Disney, you're buying a piece of the economic benefits that Disney produces. You're getting a share of the profits of the theme parks, the cruise ships, movies, ESPN, and Disney Plus. That share has intrinsic value because it generates a stream of income. So you are buying a stream of income of Disney, and that is investing. On the other hand, if you buy something, let's say like Bitcoin, you are getting no intrinsic value. Bitcoin by itself doesn't generate any income. The value of Bitcoin depends totally on what someone else is willing to pay for it. That's speculating, because you can't really project out what it's going to be worth. So people that don't know that the difference between speculating and investing will probably lose money. Reason number 2, overpaying for a stock. It's simple, right? If you pay $1 for something that's worth 50 cents, you will lose money. So to avoid this, you should buy stocks with a margin of safety. If you don't, you will lose money. So since determining the value of a business is somewhat subjective, it depends on the variables you use, like estimated growth rate and the discount rate. It is impossible to calculate the value of business precisely. If you ask 10 people to value a business, you'd probably get 10 different answers. So a good investor will not lose money if he uses a margin of safety or margin of error in the value estimates when buying a business. And reason number 1 is lacking the temperament and discipline to deal with Mr. Market. I'm sure you probably heard this analogy from Benjamin Graham from his book, The Intelligent Investor. He said that investing in the stock market is like having a part ownership in a business with Mr. Market as a partner. Mr. Market is a manic depressive fellow, or nowadays we would call him bipolar, who every day comes with a quote and offers to buy from you or sell you a share of the business at that price that he quoted. Some days when he feels extremely optimistic and happy, he would quote you a very high price for the shares. And other days when he's pessimistic and down, he will quote you a ridiculously low price. So you don't have to do anything. You should use Mr. Market's mood swings to your advantage. All you need to do is to be clear on how much your business is worth and only buy or sell when it's favorable compared to intrinsic value of your shares. So there you have it. By avoiding these 10 reasons for losing money investing, you are one step closer to making money. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.